Good morning, everyone. Welcome to another session. Today, we have another special guest. We have Doug Olsen back today to talk about insurance. I know today's forms classes, but we have a special forms class because Doug's going to go over everything in the insurance world since, the 22VV, the form that we are on right now. I will share my screen so we can get to that form first. This is a newly updated form. It's been around for a really long time, but last year, back in April, it's almost been a year since they've updated this. But the homeowners insurance addendum might want to start getting used a little more often than we've been using it. And I think that's probably why people will, after today's session, my hunch is it'll make a lot more sense on why you might, at least have the conversation with buyers to let them understand, about this. Because we ran into this. We had last year we had someone buying up what's that area there past Snoqualmie Pass and everything, that nice, expensive Suncadia. Thank you, Jason. Couldn't think of it. The Cle Elum area and stuff, but Suncadia, literally, there's people that their insurance we're dropping them. And we had someone buying in there, and the buyer, they did not have this addendum in there. And when they found out how expensive the insurance was going to be, it literally turned, the purchase, it became a thing of, well, can we even afford to do this? The buyer's like, wow, that's crazy. Like how much money they wanted for the insurance. And so they were like, can we get out of the deal? And by the time they got to the insurance part, they were like past inspections, past, everything else. I mean, it's really hard when you have a lender's like, yeah, you're fully underwritten, approved. And now you want me to deny you because you can't get or you can get insurance, but it's actually super expensive. So this is a really important thing for all of us to kind of understand and grasp this. So we talked about this at the beginning of class about whether it's a better idea for me to do the form first and then have Doug go, or vice versa. But we figured since Doug actually has pieces of this in his presentation to talk about, what type of numbers we should have in here. Because even when the form updated, I had questions to the attorneys about, you guys gave us defaults for percentages for coverage. Is this a good percentage that the buyer is going to be okay with? Like, how do we know that? And we don't, and Doug said, yeah, these are not good. So even, from breaking down the form, you guys are going to get a lot better understanding of what we should be doing here for our client. So let's go ahead and kick things off. Are there any questions before I get started? I know most people are on Zoom today. I don't know why, but Zoom people, anybody have any questions before we get started, or things you want to make sure we cover? Nope. All right. Well, I'm going to kick things off. So 22VV, this is a homeowner's insurance addendum to the purchase and sale agreement. General comments: use, attach this addendum to the purchase and sale agreement when the sale is conditioned on buyer obtaining a binder for a standard homeowner's insurance policy and binders for any other property coverage buyer selects in the optional list. An insurance binder serves as a temporary certificate of insurance before the formal insurance policy is issued. When do you guys, any buyer brokers, when do you tell your buyer that, oh, you probably should reach out to your car insurance person and ask them about getting a binder when buying this home? When do you guys do that? We'll pick on Jason since he's right here.
Usually like right when you're like submitting the offer. And then if you get acceptance, you're like, that's when you really need to call your insurance agent. Check that out and then talk with your title and escrow rep who you're wanting to use so that they can kind of help in collaboration with that.
Yeah, no, that's definitely a good idea. Do it as soon as possible. Last year also, we ran into an issue where buyer ended up, first time home buyer, they called their car insurance, they follow what the lender said. But the buyer was told from the insurance person that, oh, did you know this house burnt, like had a fire? They're like, what? No. You know, it called them like a day or two later or something, said, hey, were you aware that this house, had a fire? A major one? And they're like, no, because it was like a remodel, house and stuff. And they're like, no, that's good to know. And here the next day they had their inspection. So when they came out, obviously it came up on the clue report. But the buyer's like, I'm feeling kind of uneasy about this, and then sure enough, when the home inspector went into the attic, it's, still got the smoke stain or whatever they call it. It's left over from the fire of places of where all that smoke went. Well, the buyer was like, I don't know, should we just back out? And, and the home inspector said, no, they actually did a really good job. This kind of stuff, you could clean it, it's hard to get rid of, but it's just gonna be there. I mean, it's one of those things. It ended up being okay, but it's like one of those things, like getting the insurance taken care of right away is really critical. Cause you can't cut anything off if you don't know.
I'm just kind of thinking of a scenario that happened, where there was some trees that fell on the house years before, but that claim moves forward. And so they were like, oh, because of the large trees behind there, the binder or the price per year will be this because there's been a claim on that because of the trees so it's that all affected too, kind of remembering scar tissue.
Oh, yeah. The clue report's kind of like a Carfax, right? I mean, it's like on car, you hear before you buy a used car, like, oh, pull the Carfax, get every history and everything on that. That's what the clue report does, and insurance people are the only ones who can get that. So is that easily? How do you get that stuff, Doug? What's the process look like?
Whenever someone's put an offer on a home and they're saying, hey, we need to do a policy on this and at least see if we can get moving forward. When we're going through the underwriting process, not the quick quotes, right? Everyone can get a quick quote in 15 seconds.
Right.
But we're actually going through the underwriting process. That means we've got their name, social security number, birthday, current address, we've got all their information and we can pull that trigger. It'll tell us all the claims that have happened at that property, whether it's thefts, fires, all this, it'll tell us everything that's happened at that property. At least what's been recorded. It doesn't mean that they failed to, or they chose to not make a claim or did not tell the insurance agent, or the insurance company, excuse me, about the loss. We're not seeing any of those. We're just gonna see where claims have actually been made, including, hey, should I make a claim? No, okay, thanks. That'll actually be there as well.
Oh, wow. That's good to know. All right, let's break down the form real quick. Assistant fill in the blank, obviously, and we train off the forms manual. Manual gives numbers to each item, so you can easily identify like what you're looking at. So obviously 1 is the date of the contract, 2 is the buyer's name, 3 is the seller's name, and of course 4 is the property address. So the first thing we had to break down is the premium and deductible. It says insert the maximum premium and deductible amounts set by the buyer that the standard policy of homeowners insurance binder may not exceed. Under this contingency, insert premium and deductible caps set by the buyer for each additional coverage the buyer selects from the optional list. Are buyers gonna know what? No, there's no way. Brokers don't even know. I mean, that's the truth. So I'm really glad you're here to talk about this stuff today, Doug. So when you look at number 5, it says this agreement is contingent on buyer obtaining a binder for a standard policy of homeowners insurance at an annual premium not to exceed blank percent. So if you do not fill it in, and this is what the attorneys set in as the default, is half of 1%, if not filled in, of the purchase price, with a deductible not to exceed $2,000 by default. Exclusive of all additional coverages, example, art, jewelry, earthquake, etc. So first things first, in the form, you have to decide what is this percent, and we'll wait till Doug does his full presentation till we get to that information on what we should be doing here. But Northwest MLS attorneys came up with this amount as being the defaults. So in addition, number 6, we'll look at that one. So optional insurance coverages. This addendum automatically makes it a contingency for the buyer to obtain a binder for a standard policy of homeowners insurance at or below the specified premium and deductible amounts. If the buyer desires to include obtaining a binder for other coverages as part of this contingency, mark the box for each applicable coverage. Note, if the buyer is obtaining a loan, the buyer must mark the first optional box for this contingency to include obtaining additional coverages required by the buyer's lender. So now you've got the option of additional coverages. So here is number 6. So it says, in addition to obtaining a binder for standard policy of homeowners insurance as set forth above, this agreement is contingent on buyer obtaining a binder, and you select all that to apply. So it looks like they've kept the exact same caps on each one of these. So the first box choice is additional coverage required by buyer's lender at additional annual premium not to exceed the same percentage caps, the same deductible amounts too for $2,000, and of course half of 1% of the purchase price if not filled in. So flood insurance, landslide, earthquake, and then blank insurance. You write in whatever the other insurance is. Brokers, we don't even know what would be an optional insurance. Do you have optional insurances too?
It depends upon what their intent is of this document, and maybe they're leaving it wide open.
Yeah.
For a reason. But you have landslide, earthquake, and flood broken out. There's also a difference in conditions policies that encompass all of that instead of it being individually.
Gotcha.
There are, or hurricane, like if we're talking about somebody buying something in Hawaii or something in Texas or in another state. I mean, so this has to be somewhat generalized.
Yeah, that
so
makes
that it
sense.
can not have to have 1,300 different copies of which one are you using.
Yeah, that's good. Okay, that makes
Or
sense.
someone's running a business out of there. Too, right?
Yeah, but that wouldn't impact the buy and sell agreement at that point because why would you as a homeowner want to buy a property that also has a business operating on it? Right? And so that would be more of like a business transaction, most likely, where you're buying the business that also happens to have a home. Right? Does that make sense?
Yeah, because I have this thing I'm bringing on that there's a detached shop that they do auto repair, but it's also part of the home as well.
Yeah, but is that auto repair going to stay there when they go through that transaction?
It's there now, so I was just wondering, like if someone was to move forward with a different business and because that's who we're marketing it to. Like we're gonna market to people who may do like auto detailing or someone who does repair, maybe
Restoration of car restoration.
Yeah, so because the shop is so big, that's kind of the selling.
Well, I'll probably do a little bit more justice in my presentation, but I want to answer this specifically. Significant caution. When we talk about the State Farm, Safeco's, USAA's, Geico's, Progressive, the markets that most people are going to get insurance. 99.9% of them are going to say, we're not looking to insure a home that has a business that creates foot traffic on our policy at all. So you will have to work with companies like Nationwide, Safeco, Liberty Mutual, where if they're at least insuring that business, then at least they know they have control of both of the policies and they know what the policies that have been written. It is not as easy as I need a home quote. There's a lot more work that's going to go into it. So if somebody calls, just gets a home quote and someone's just doing a quick quote, right, to get the answers done, and they're not asking the questions. Why is there a 4,000 square foot shop on here with RV size doors on it? What's going on with the structure? Why are we not talking about that? And then they find out, well, there's a business running out of it. Well, now we have pollution control. Now we have foot traffic. There's all these, now it's a business exposure. And we're talking about, I just want to live in a home and cook my dinner, right? Those are two very different risk factors that need to be taken into consideration by the carrier.
Could you use, like that scenario, would you put that on the other and say, running a business out of there and need to get a binder for, underlying property, which is the house, and then the other one would be the business?
I don't want to say you should or shouldn't do that. Here's what I would advise. I would advise that that should be here because I'd want to know that that business exposure exists. And if they can't find an insurance carrier to insure the home for the price that they're looking for, because the business side is kicking it off of the acceptable in the underwriting guidelines. Remember, becoming AI and black boxes. It's not like you and I have this conversation right now.
Yeah.
Let's figure out a way to make this work. A lot of things are just becoming, it didn't fit. It went in, but it didn't come out. No, you can't get a quote,
Yeah.
right? That's gonna be the challenge. So what could kick that is the business side of it.
Yeah.
And of course, if we're talking about, I'm just gonna sell diapers and it's a drop ship and all that ever shows up is UPS, FedEx and the post office, that's not really operating a foot traffic business or a pollution situation. So I don't want it to just be thought it's somebody can make $4 or $5 million selling diapers. I have a client that does this, by the way.
Wow.
He converted his barn, sells $4 or $5 million worth of diapers throughout the year, throughout the world. And that's all that shows up is once every 2 or 3 days, a vehicle shows up for whatever carrier and there goes all that product or drop
Then you
off.
just have insurance on the product.
Correct. And so the structure, and I feel like I'm taking
Oh,
over.
sorry.
No, you're
The-
good.
The structure, depending upon how they have properly separated this risk, like let's say they created an incorporation. That incorporation is probably subleasing from their LLC or their trust, right? So they're now responsible for the insurance of everything interior wise. Does that make sense?
Like a rental policy.
You're 100%, or a landlord type policy. So they would have a landlord policy. Can think of it like an ADU, but business,
Right.
if that makes sense. Like a lot of people are.
So you're insuring the structure, but then the LLC, which is running the business, is the tenants.
Correct.
Have their own policy.
Correct, but they can't insure the structure,
No, they
right?
own it.
Correct, yeah,
Yeah, yeah, no, so that's
strategy.
Yeah, yeah. So with that thing, why would someone that ran, say, a hair salon out of it, because they have
Same.
traffic,
Same, they still have to have that conversation.
maybe they would rent the chair to the house and then they're the tenant, and then you had a standalone business policy.
They need to talk to their lawyer,
Yeah.
talk to their CPA and talk to their insurance advisor. If they only do one of those, there's a broken leg and it's not gonna work out well for them.
Yeah. Oof. Nice answer, thank you.
Man, good stuff. That's exactly why we brought Doug in today, man. That's exactly why. All right, let's look at number 7. Insurance contingency, insert the number of days that buyer will have to make application for homeowners insurance and each additional coverage the buyer marked in the optional list. Note that if buyer fails to make application within the designated period of time, the insurance contingency will be deemed waived. So just like a home inspection contingency, you got a deadline, and the deadline does not repeat. That's it. So if you're gonna say it's gonna be 5 days to make the application, but make sure the buyer makes it by 5 days, and obviously that's business days for 5 days and less, because of computation of time. But then the next thing we gotta look at is number 8, where it says the insurance deadline. This is the actual deadline, is insert the number of days that the buyer will have to give notice of buyer's inability to obtain complying homeowners insurance and each additional coverage the buyer marked in the optional list. Form 90VV, so that's the notice, that's what you're gonna do a response for the buyer's notice of termination, homeowners insurance is unavailable, can be used to provide this notice. Again, if the buyer fails to timely give notice, the insurance contingency will be deemed satisfied or waived automatically. So you got the time to make the application. It's kind of like, 22A, you got the default 5 days to make loan application. Same thing, 5 days to make the application for the actual insurance and any additional coverages that the buyer needs. And then the next step, let's look at that 90VB. Not too quick. Let's see if it gives for approval too. My hunch is it's got both. The attorneys usually do that. Oh, it's just the notice of termination, so that insurance is unavailable. So I guess it is only man, you would think, because how do you give the notice they've approved it? They don't. That's kind of weird. I think that's one I'll talk to the attorneys about and on the forms committee too. It's like, why isn't it both use? Because you know how we do like for feasibility studies and stuff like that. Like we want to see an acknowledgement come from the buyers, because being on the listing side, you're sitting there waiting like, is it good? Are you guys good? If it's defaulted to, let's see, what was it? Is it 15 days by default? Yeah, 15 days to get, approval, or to get, to know you're gonna be okay for the insurance. I mean, if you're past that, I don't know, how long does it take to get all of the information you need to make a decision, you think, Doug?
I'll
for
go
those
into
ones?
more details, but this specific area is the most troubling. And so the easiest way to explain it, there's at least 2,200 insurance carriers out there, right? So it's not like it's just, there's a 7-Eleven and a Circle K and those are the only two.
Right.
There's over 2,200 insurance carriers out there. Of those carriers, let's use Clay Elum as an example, or Chehalis or Leavenworth. There's like 3 companies left that are even willing to offer insurance. So when you force all of these sales and all these non-renewal notices, and now you're forcing all this work on a limited number of carriers, they're also becoming overwhelmed with work. So it's not like it used to be. And you're asking a human underwriter to actually get involved. So it all depends. It could be clean and easy in 20 seconds.
Yeah.
And it could be that it would take a month.
Whoa.
Because now we might have to go to what's known as the surplus lines. Or for those that know the term Vern Funk insurance, bad driver,
Yeah.
right? That's kind of what the surplus lines is, although there are significant, amazing things about surplus lines. They work at their pace. They do not work at our pace. And when they're one of the 3 entities, so to speak, that can actually do the insurance,
Yeah.
we're at the mercy of how fast can that underwriter do all the things underwrite. WSRB, what's the fire rating? What carrier can I actually, get, there's a lot involved in that. So this is actually the one that is why what you're doing, Jason, is absolutely the advice I'm gonna say. In fact, I have a slide in my presentation that we'll come to. It basically says, congratulations, celebrate, the offer has been accepted. The next phone call needs to be your insurance agent, not the designer, not the contractor, not the painter. It needs to be the insurance agent to make sure that you are all over this and you don't lose 24 hours, because you could lose the deal simply because one day was lost.
Yeah.
Because of how much time it's gonna take. And remember, I'm talking about not quotes. I'm talking about underwritten. In fact, that's one of the notes I just took. A lot of people say, call your agent, get a quote. You're using a great word, binder. Binder means this needs to be underwritten and ready to be issued. But that also to an insurance agent means put the policy in force on this day, which can blow up in your face, because what was underwritten today and was acceptable and that policy's in force, what happens to closing days?
Moved.
Right, and so now most insurance companies, if they need to move that closing date, all bets are off. They have to re-underwrite it because the date that was approved is no longer available. So that time spot of I blocked out and said, I guarantee you this quote for the next 30 days, and somebody says, I need a binder, click, that trigger's been pulled, that the gun's been fired. So that quote no longer is secure. It's now a policy because you asked for a binder. That makes sense?
Yeah.
So if you come back to them again, it's like it's a brand new quote. All bets are off.
Yeah.
Whatever the new rates are, whatever the new underwriting restrictions might be, that's what happens. So we have to be very careful with this dance.
Wow.
It's like pre-approval to pre-qualified.
Yeah, 100%.
Yeah, that's a great way to put it, Jason,
Yeah, so
actually.
I had a transaction last year that was a wedding venue, beautiful home, old farm.
Enumclaw area?
Enumclaw,
There,
that they changed the barn into the venue.
Yeah.
And they had to go to 3 different, and we represented the seller. The buyers had to go to 3 different insurance companies because of the barn.
Yeah.
And it didn't have water.
Yeah, I happen to be familiar with that.
You know what I mean?
Did you know something to do with the city?
Yeah.
Yes.
Yeah, so we had to go to, and also we had a unpermitted, rooms.
Yeah, it happens. Yeah.
And so we actually had to get an extension because of, the insurance and the
Yep.
improved.
Yep.
Question for you, Jason. Did that deal have a 22 BV in it?
Nope.
Yeah, so see that's the type of thing, like, I want you guys to like really remember is like, you're gonna come into these transactions, you're gonna have these different types of properties that are
Usually
definitely
it's more of the.
different, unique.
Like if you're in a subdivision, you're probably pretty safe. But if it's like a weird, funky.
Ask Palisades how that worked out.
Oh, yeah.
You gotta understand, insurance, it's a transfer of risk. This isn't a commodity. You're getting into a legally binding contract with an insurance company by saying, here are the answers to all of my questions. Is that acceptable? Yes. Here's my money. Here's my signature. I agree to your contract language. So when claim day happens, if what we did wasn't what we said it was, that reserves them the right to say, you're in breach of contract. We don't even have to cover your loss. So there's a lot of things we have to be super careful about. That's why I'm using the word quote is dangerous. Binder also has some challenges. What you really want is I need an underwritten approved quote.
Yeah.
So binders, we just talked about challenging, quote, not smart. I can get 1,200 quotes on a home right now, but as soon as I go to underwriting, I might only get 4 offers back.
Yeah, yeah, cause I've also, when I was dealing with the wedding venue, when I was talking with the other broker on the other side, they were talking about how you should work with a insurance broker instead of the actual company, because a broker has access to all kinds of different like companies that could do like unique situations, and that would have been better for them if they would have they've been working with a broker instead of reaching out to A by ABC, XYZ, and it would have saved us a lot of time.
Yeah, and my slides look like there's a lot of them, but there's some points to it, and that's one of the points. It's the first thing you need to do, no different than why'd they hire you, Jason?
Because I'm so good looking.
Okay. I'm only picking on Jason because I got his name. I didn't get your names, but why would they pick you?
I'm Cassandra with Fortis.
Oh, you're Cassandra. All right, good to see you.
So I'd love to sell you a home, but I probably shouldn't.
But why do clients pick you?
Probably because we work at building a connection with them, the way we know we're meeting their needs.
All right, how about yourself?
Well, they probably wouldn't pick me because I'm not licensed yet.
Yeah.
You'll get there. Why would they pick you? All right, well, let me help. The idea here is when you're helping someone, it's one of the biggest financial decisions they're going to make, and it's very emotional. And so they're going to want to work with someone that they trust and they feel are going to guide them correctly and listens to what their needs are. They're not being hawked a product, right? Does that make sense? This is a real transaction. This is not what color shoes should I buy this weekend. This is a big deal. It's a long-term situation. So what I'm saying is that's exactly what they should be doing with whoever they're going to do business with our insurance. Because it is so complex today, and everything's a contract, it's all legal mumbo jumbo, that's exactly what they should be doing when they're working with an insurance advisor. They shouldn't just dial 800 numbers, and they're thinking, if I can buy a gallon of milk at Safeway, it's the same thing at Fred Meyer's. That might be the case. But 100% of every insurance carrier has nuances that makes them different.
Yeah.
Whether it's how they pay the claim, how they treat the client when the claim is made, coverages that are excluded, included, all these things. So no different than financial advising. They pick you because you've earned their trust and they know that you're going to walk the walk with them. You're not selling them a product.
Yeah.
So in here, that's really what I'm saying is, if you don't talk to your CPA and you don't talk to your real estate attorney, you don't talk to your insurance agent, to trust LLC in my name, if you don't have those three having a conversation, you've got a broken leg and it's not going to work out well on claim day.
Yeah. All right, we are done with the form, you guys. Obviously, in the event that the buyer was to terminate based on not being able to get insurance, or it was too high over the caps that you wrote in, you would using the 90 VV to give the notice, and of course, you need a Form 50 to include it to return the buyer's earnest money. Any questions about the form before I hand it over to Doug? Zoom people, anybody? All right, I'm gonna stop my share here and we're going to go ahead. Share over to here. I don't know if you have any videos or clips or any sounds, but we'll get those ready just in case.
I hope.
Let's
That could be embarrassing.
see, I wanna hide this. And. All right, we got this ready for you, Doug. Here you go.
All right, you got a magic clicker?
I do, it's the worn out side there.
The one with no button
No
anymore?
button anymore.
All right. Well, good morning. Thank you. Thank you, Cassandra, for coming down here.
Yeah,
Appreciate you.
absolutely.
I hope it works out well for your brain and don't give you a hemorrhage.
I love learning something new, and who doesn't love insurance? I mean,
I don't know if does anybody love insurance? So one of the things I would like to say as I get started on this is, for me, this is more about a passion. I've gone through some challenges with how insurance works, and so this is why I've continued to evolve as a person in this industry. I'm becoming what I'd like to be considered as an expert. There's much smarter people than me. I just like to be in the conversation. So I passionately want to help people about it. It is not boy, can I get them for the $500 for this policy or $428 for this policy?
Mhm.
So a lot of my conversations with folks have nothing to do with the premium, because when they learn what they actually are paying for, it probably doesn't align with what their needs are. Okay, and so I just thought I'd talk a little bit about USI. We've helped over 500,000 clients. We're the 5th largest privately held broker in the country. We have clients across the entire United States. Last year alone, we did $3 billion in revenue. Revenue, not sales that people paid, revenue. And so as a point of reference, it's pretty impressive. We have over 10,500 agents. I'm one of 200 agents across the country in the role that I'm in. So I'm actually paid a salary. So it doesn't impact me if I sell somebody a $500 policy or a $10,000 policy. Now, do I have a bag of carrots that says if you do a really good job, we'll give you extra money? Yes, of course that exists. But the idea here is as an advisor, we should be really having a back and forth conversation about what are your needs specifically. Like we were just talking about that business transaction. If you call most agents, it's just going to be, what's the address? What's the square foot? Blah, blah, blah. Here's a quote. They're not asking the questions about how's the property going to be used? Is it a VRBO? Is it a long-term rental? Is it a second location? Is it becoming a new primary? So with that, we lots of awards. We're a pretty amazing company. We've got 8 years in a row. Most of these awards have been happening. I won't bore you with all the details. This is me specifically, so that you have a little bit of credibility on where I'm coming from. I'm actually an accredited advisor of insurance. I'm not just a licensed agent where I do my 24 hours over a 2-year period and say, I still have my license, right? That at the time when I did that was a 2-year degree. Only 12 of us got that. At the time when I did that back in 2017. Now it's like a 9-month course, and they don't have to fly all over the country. It's nice. It's very good, but it's not as fun as what I went through it. And I'm also a chartered private risk and insurance advisor. So you're probably going to hear a lot from me about, hey, it's not just can I get the insurance policy? I'm going to save $500 if I go to Allstate, or I'm going to save $500 if I go to Safeco. It's about, well, what are the risks? Is there water near you? Or is there an equestrian center near you? Do you have kids in the household? What kind of roof does it have? What are the trees? There's risk factors involved that we really need to go through. And really what this talks about is it gains credibility for me. So like if we're talking about private offices, this is telling the private office that I have the knowledge and the wherewithal and the tools to help high net worth and ultra high net worth clients. That's the easiest way to say it. It says, yes, this is an individual that will guide your clients in the correct fashion. And then I'm a personal cyber risk management as well. A lot of people don't realize this, but we're not going to talk about it too much today. This is the #1 problem that we have right now in the United States as regular everyday individuals, whether it be through social engineering or them getting into our system. So that's enough about me. USI, basically what we do is this. We want to have a holistic conversation, and we're going to flip the script. Most insurance companies are going to say, how much you paying now?
Yeah.
And how much is it going to take for me to get your business? We aren't in that game. What we are doing is we're saying, we need to know what your risks are. We're going to actually let you know about some risks that you're not even aware of, that you didn't know was something to be concerned about. And we're going to offer you tools on how to reduce those risks. And at the same time, if you'd like to continue forward, then we're going to be able to show you the carriers that are going to best fit your needs. Okay. One of the things that we do to help in that process is we have a proprietary analytics system that no other agency currently on planet Earth has. We built this system. It allows us to ask some very basic questions. So there's 150 years of claim history and knowledge in this system. 150 years plus. And so while this looks really basic, I just want to bring your attention that it's for any state and any county in the United States. So this database has all of this information inside that. And we'll ask certain questions like, do you have anyone under the age of 21 in the house? Do you have animals interact with guests? Do you have an estate tax plan? Do you make more than $500,000 a year? There's these real basic questions. And then what this will do, by how this individual answer these questions, it'll dig into our proprietary system. And let's say an individual is concerned about reputation harm. Let's talk about that really quickly. So reputation harm. Well, let's say you have someone that represents a company, right? Whether it's a small little diaper company or it's a Amazon or a real estate agency. and someone starts slandering them online. How's that work out normally?
Usually not good.
Right? And so there are companies that can actually monitor your name, your business, the whole 9 yards to come in and keep that clean. Now, they're not going to get rid of legitimate. A person said, you told me I was going to get 3% interest rate and it ended up being 7%. And the mortgage company didn't do what they were supposed to do. I'm just using it as an example. That they can't get rid of. But if somebody's out there just trying to be impolite, they can get rid of it. Maybe wealth protection's a concern for them. Maybe they have an au pair. They need to understand the exposure that the au pair has, or they have a chef, or they have on-site landscaping, or maybe it's cyberbullying. I'm just gonna jump around. Maybe it's water damage, fire, protecting your valuables. There's a lot of collectibles. A lot of people don't realize the home insurance isn't going to cover collectibles over about 5 or 10,000, yet they're buying $30, $40, $50,000 pieces of art, or whatever, or watches, or whatever the case may be. Dog liability. So I'm not going to bore you with all these, but let's just say we picked maximizing your wealth protection. You'll notice right here, that's dark blue here, and these are light. It's because I've already gone past these. We asked questions specifically about family. We ask questions specifically about what kind of properties and vehicles they have. And then we get into their profession and their activities. And as we go through and we answer those questions, it's actually telling them, hey, you have a medium concern here. I mean, over 30 points jumps into this. And what does this mean? All right, so if you might have noticed on this screen back here, by answering all those questions on the other screen, it's actually saying you have up to a $17 million exposure. And I want to pull up here and just say this. Most people don't even have an umbrella. And we always advise that they have an umbrella. And we can get into details about that. But basically, it's an extension of liability protection that protects your assets and your future income if you cause harm to someone else. The home policy and the auto policy just cannot get sufficient amount of coverage on it. And let's say you have $500,000 in coverage and you want to go to $1 million of coverage, you're probably looking at $1,500 in increase in price, okay? But if I offer them $1 million umbrella that stacks on top of their motor home, their home and their automobiles and their motorcycle, it might only be $800 for $8 million of coverage versus only an additional $500,000 of coverage. Does that make sense? And so now we're stacking that $1 million policy on top of that $500,000. I have $1.5 million in protection instead of just $1 million on only the autos. So now it spreads for all of their policies. And the reason I bring that up, and I don't have that screenshot up here, but if you Google it, what is the average severe auto accident in Washington State? It's currently $489,000 for an average severe auto accident in Washington State. That means everywhere. That's state. Yeah. All right. So this breaks it down. I showed you the 17 million a few moments ago. This person doesn't have that full exposure. Remember what we're talking about here is this is a claim history and knowledge base. So it's not made off of, I slept at a Holiday Inn last night. And so I think I'm pretty smart. And here's my opinion. Well, they can ask my opinion. What I'm trying to demonstrate here is we have a system that actually says to them, you specifically have this exposure based off of claims paid history and our knowledge base. Does that make sense? Much different than an opinion. And so when we get to this, you'll see that 17,000 dropped to 10 based off of that. They're not fully exposed. They didn't get into the red. So maybe they don't have a 21-year-old in the household. Maybe they don't have a kid away in college. Maybe they don't have any animals. There's a lot of other things that can go into that. And so what happens here is we can do a drop down. We can do 18 to 25. We can do all these age differences here. We can do all these income differences, or excuse me, asset differences here. There's a whole bunch of them in these drop downs. Same with the income and what they're projecting for this individual. With their only being 45 to 51, they have this in assets, and that's a range of their income that they have a future income of about $7.2 million. And they're saying that you need to at least have 10,725,000 in liability protection. Now, will I say to the client, hey, that's what you should do if they have no umbrella? No, I'm going to probably say you should at least have 5. Let's at least start with 5. Let's not, become insurance poor, but you're absolutely not in the position you should be in at this moment. Then we get into these kind of conversations. I told you that there were some questions about property and stuff like that. I want to bring this to everybody's attention. A lot of folks don't understand that if you buy a home and it's in your name, and then you talk to your CPA and you guys decide to put it in a trust or an LLC, but you don't tell the insurance company, think there's any insurance on that property anymore? Now, there's always nuances, and I wanna make that clear. Everything I'm talking about is about 40,000 foot elevation. But you have to have that conversation. It depends upon the severity of the loss and the type of loss. Okay, but if we don't report to the insurance agency or the insurance carrier that this is now owned by the LLC, think about it. You go online, you look at King County records as an example, and it says ABC Trust. Is that Fred and Shirley Smith or Shirley and Shirley Smith that owns that property? Or is it the trust? It's the trust. So if Shirley and Shirley have their insurance policy on that property, what coverage do they have? They don't legally own the property. The trust does. See where I'm going with that? So it's an exposure you have to be very careful with, have that conversation, whether it's an LLC, doesn't matter. You just got to make sure that you're making certain that if you can at least add that trust as an additional insured, not additional interest, two very different things. You're not a bank loaning, you actually own the property, so you need to be an additional insured as a trust. Does that make sense? Whether you can add it to that policy or it needs to become a brand new policy. So as we talk about this, here's my advice. Talk to your CPA, talk to your real estate attorney that's helping you do this transaction, and talk to your insurance agent before you finalize the documentation. Because you need that new policy to go in force the same day the deed is being transferred to that new entity. No different than buyer to or seller to buyer. That makes sense? That's exactly what that family just did. Okay, so we actually, I hope I'm helping here. This is kind of the depth that we get into to say, hey, are we going about this the right way so you don't create an exposure that's gonna make you go bankrupt on the first time you have a claim?
So a question on that, so if you have like you vested in your personal name when you purchased it, you put it into your family trust. You add the family trust as named on the policy, you claim it out to do a refinance on the property, because you can't do refinance in the trust.
Yep, that's right.
So as long as you have both of those people listed on there, those entities, natural born and then your LLC, you're protected moving forward as long as you're using that LLC name.
Yeah, and here's another point as well. A lot of times people will just put let's say they only do the LLC or the trust name.
I could purchased it in the.
Like the entity did, right?
Yeah,
Let's say that happened, right? And they're done, right? It's all paid for. There's no bank anymore. It's like done. We're doing this to protect our kids and they're not gonna have to pay 30% to somebody else. Okay, let's just say that they're doing that. Well, question for you. Since the entity now owns the structure, where's their liability protection? Where's their stuff that's inside the building that they're using? Where is its protection? They have none.
Crazy.
It's gone. So they need to be added as additional insurers on that trust's property, or have a contract where they're leasing that property for $1 a year and go get a renter's policy that protects their stuff. See where I'm going with this? All of this is a strategy. Each one's gonna be different. I'm not trying to cookie cutter everybody into one box, but each transaction is gonna be different. That's why they need to work with someone that's an advisor.
I wonder how many trusts are just hanging up there like that.
A lot.
Or even LLCs, right?
At least half that I come across are wrong.
Scary.
At least half.
That could be a farm right there. You could reach out to everybody and say, hey, we've done a little farm research on you and it looks like you have transferred from natural born name to your LLC. Have you updated your insurance? If not, we have somebody that could do it. And if you want to sell your property, we can help with that.
I'd lead with the sell part, but yeah. All right, so I just want to give an example. So as I start from here, I'm talking about your 22 BV. What I'm trying to do here is I'm trying to give you a little bit of history and a little bit of backwoods knowledge. You know, I like saying things like this, and I'm going to ask for participation on this question. Has there ever been a time, and I want you to raise your hand if there has been, we don't need to hear about what, but has there ever been a time in your life where you felt if you had just known something, someone taken the time to tell you something, that you would have done something differently?
Absolutely.
Everybody's hand should be in the air. Well, from the smallest little thing, woulda, shoulda, woulda, coulda. Yeah, but when we talk about insurance, this could, look at it this way. You're buying a house, it's the biggest financial decision of your life for 90% of everybody, right? And then we just spend 15 minutes to figure out how to protect that significant. What? Why are we doing that? We need to take just as much time, energy, and effort to get that done, right? And that's where someone like myself comes in to say, hey, this is really where we should be helping each other. We should be coming together. We should be working together and figuring out what your risk tolerances are. So we can figure out what you need for a deductible and what you want to give the insurance company, what you don't want to give the insurance company for insurance premium, and what you actually want the insurance policy to do for you on claim day. And then that takes us into what we're talking about here for the 22 BV. So think of me and this portion as I'm your secret squirrel with a significant amount of knowledge to help just give you little bits and pieces to help your buyers and sellers understand what they're currently up against in the insurance industry. This is fluid. It changes all the time. It is, in fact, I'll just say 5 years ago, you could easily just put one slide up here and say, this is what most insurance companies are looking for. Now I need to put 2,200 different slides up here because no two insurance companies are the same. But what I did do is I tried to condense it down. If you work with your client, say, please talk to the insurance agent as soon as possible, and they listen to you, and then that agent's saying, I'm getting a bunch of declines. Here's what's happening. Let's say you're going into Safeco as an example. And Safeco, you put the name, the address. The next screen says, please click this button to do an assessment of the location. And it does its own magic in the background. And it says, no, it's in a fire area. We will not offer you a dwelling fire, which means landlord, or a home policy. We will allow a renter's policy, right? So this is only, if you only want a renter's policy, we'll keep going. And you might say no condo, no renters. It just depends. So we have to check every address with every single carrier. Can you do that in 15 seconds or less? It's not happening. So that's the difference between quoting and underwriting. We haven't gotten to underwriting yet. That's just pre-bind, right? So now they've installed this thing called pre-binding. So now we have companies who are saying, I want photos of the kitchen, the bathroom, the garage, the water heater. So what happens is the screen will pop up. Let's say it says, yeah, this is acceptable, but, and then the screen will pop up and say, we want all these things. And now you have to submit it to us. And you were asking a little bit ago, Eric, about time. Guess how many days they tell us this will take for them to analyze?
10 days at least.
30. 30 days. Most homes you want to close at 45, right? Is that still
30.
Okay.
30 is about closing.
Well, I'll take 2 million cash, 10-day close if anybody wants to. I'm just saying. But and all joking aside, I'm just showing this to you. So if we see this screen, guess what? We're not wasting 5 more seconds with this carrier. They're basically telling us we can't tell you no, but we're going to make it extremely painful to get a yes. Does that make sense?
Look at the amount of photos you'd have to do.
Yeah, and not like, I mean, look at this proof of ownership. How do you prove something that you haven't even bought yet, that you own it? So guess what's going to happen? The system's going to reject it because I can't give them all of these things, right? Anyways, I hope that's being helpful. Then you were talking about non-renewals and some challenges. I wanted to bring this slide in. And I'm going to walk back up here to the screen and show what this is right here. This is the source. So this, one of the things I want to bring everybody's attention, everything I'm using, we can all go get off the internet and we can all do this research and get. This is not an insurance person pulled information together and this is what they want us to think. This is me staying as much as possible out of the insurance industry and using third-party information. So this was actually collected by the US Senate Budget Committee in 2024. This is a June 2024 report. Most of us just think there's a whole bunch of cancellations in Florida. There's a whole bunch of cancellations in Texas. Wow, wait, Texas doesn't look that bad. Why do we all think that? There's a whole bunch of cancellations in California. Yeah, I don't know if you guys noticed, but there's more than 3 states in this country. I'm being funny with that, of course. But look at the impact. So this is 1 out of every 200 policies gone.
Damn.
Being non-renewed. Now, there are several reasons for this. Some of these insurance companies are tired of hemorrhaging money, and they're just saying this is no longer a smart business model in this zip code, or this state, or that county, and they're saying, we're out. Okay, and so that what happens there is they're just sending non-renewal notices as those policies come up for renewal 60 days before what would normally be a renewal. They're letting them know that they're leaving the market and that now we aren't going to renew that policy. And so now this person's like, wait, my auto, my umbrella, now they have to go and redo this whole thing all over again, because if you don't take the auto with the home, now the auto's gonna go up 25 or 30% because you lose the home auto discount, and the home's gonna be more expensive, right? So all I'm trying to show you here is, and just think of all the hurricanes, the tornadoes, the freezing that's happening, right? And I don't know if anybody saw this, but earlier this last, like, I think it was about 3 months ago, the Weather Channel, you know how there used to be Tornado Alley?
Mhm.
I call it a pot now, because it went from to wolf, right? I mean, look at Oklahoma. Right, so it's what I'm hoping I'm helping you guys understand is this is not just a local situation. When you have insurance companies with millions of clients across the United States, they have to make these decisions on how are they going to move forward. And as these companies all leave those areas, or they're reassessing what they feel is acceptable, you also have in this as well, you're going to have, hey, I want to shrink my underwriting guidelines. I don't want to let certain houses in here, so I'll quote it. Like I just got done showing you about, no, thank you, we're gonna pass, we're not gonna continue on this path. This is where you're seeing a lot of this also come into play, because individuals said, I'm gonna start self-insuring because I can't find a policy. Or my old policy was $1,500 and now they want $12,000, right? And so we try and help people understand all this, but I'm just trying to show you, this is why the 22VV is so important, because it isn't just a local situation. It is a countrywide problem. And where is this coming from? And I'm gonna go kind of fast through this, but the blue is basically the actual loss ratio from the insurance companies. This orange is the loss adjustment, the expenses to defend, to analyze, how much should we actually pay, all that stuff. And then the red is operating expenses, all the other stuff. So if we were operating the perfect insurance company, we would want to be at 90. 90 to 95 is considered you're doing an exceptionally good job as an insurance company. You're pulling in the right amount. If you get below 90, you're ripping your people off. You're just pocketing money. And that's not how insurance is supposed to work. It's supposed to be a good, clean dance between how much you charge your clients and how much you're allowed to make. Just being honest with you, that's how that is measured. So you don't want to see anybody under 90. So you got to go all the way back to, anybody remember what was happening in 2005, 2006, and 2007? Anybody remember? Eric?
Well, yes, beginning of the mortgage meltdown before.
Yeah, this is where their real money was happening, right?
Yeah.
This is where we all learned about it in 7, 8, 9 and hemorrhaged in 10, right? But look at, that was the only time they fell in the window. And I'll tell you why. Because a bunch of banks were now taking on all these properties, and there weren't fire claims, there weren't theft claims, there weren't wind damage claims. They're just selling these properties to house flippers. So the insurance claims actually dropped. Think about that, right? Okay, and then we have to go, look at this. I mean, this is almost 10 years to get back in to where we just did last year. We finally got back into, this is the insurance industry. Okay, this is all of it being calculated for your home and auto in one clump. This is not life insurance. This is not financial advice, financial investments. It's not life insurance. I think I said that already. Health insurance, that's what I was trying to get to. This is just P&C. And so I just want to bring this to your attention, because anytime you get above 95, the insurance companies are losing money, literally. They're losing money. It's not a smart move. So that's why they've been asking for all these rate changes that we're all experiencing, because they have been hemorrhaging money for almost 20 years, like literally, okay? And then that brings us to this one. A lot of people don't realize there's this reinsurance market. And I won't bore everybody to death with reinsurance, but this is actually extremely important when we're talking about high net worth households, and you're talking about a $4 or $5 million house. When you're talking about Allstate, State Farm, Progressive, Safeco, they were all created 50 to 100 years ago, and they were built for the 1,200 square foot house with one car. And look how we've all grown into, now it's a 2,500 square foot home and 4 cars, and a motorhome and motorcycle. You know, we have a lot more stuff than we used to, but they haven't really changed their book. So what they do is they try and leverage the insurance that they're selling for this $4 million house by reinsuring half of that. They're buying a big chunk of money to say, okay, we added $1 billion to our insurance portfolio, but the way our rates are, we can only expose $500 million. So we have another $500 million in reinsurance. So if something goes wrong, Palisades, now the reinsurance market is going to absorb the overage, right? Does that make sense? And now we can control our rates a little bit better. But what you don't understand is they still have to pay for that. So they're buying their own insurance policy to hedge their own bets. Does that make sense? And so ultimately we end up having to pay for that. So this again is why strategy is important. That takes me to this one. Of the top 19 global reinsurers, they only did 11% of all the losses in 2024. This is why you see so many insurance companies still having to raise the rates, because they're absorbing the lion's share of these losses. Does that make sense? Does anybody here have the ability to control hurricanes? Tornadoes? Earthquakes? Hailstorms? Yeah, but man, there's some years that we just missed.
Windstorms?
Yeah, windstorms. Look at the ice storms that's going through right now. I mean, you just see these trees exploding because of the weight of the ice on them, right? So I just thought it would be appropriate for us to ground ourselves. Look, even the reinsurance, even the insurance market has to get reinsurance because there's so much risk and so much exposure. They can't cover it all without going bankrupt or needing 85% rate increase instead of 20. Just being honest, right? So this is about the method of moving money around so that we can all still afford the insurance. That's what this boils down to. All right. So now we're going to talk about homes. Let me ask a question. How many people here feel that Washington has one of the most expensive home insurance policies?
Or not?
We're not. We're not even in the top 10 list. Look at these states. Texas, the average price for a home, $6,500 on insurance on an annual basis. And by the way, over 50% of every home isn't even insured properly. We're going to get into that here in a minute. So imagine if they actually insured it properly, that's probably going to move a little bit. So whatever you do, don't buy anything in Florida. No, just kidding. Buy everywhere, sell everywhere. But you can see that. And so this next screen is me kind of having a little bit of fun. But I did get this, by the way, from realtor.com. So again, didn't get it from the insurance industry. This is realtor.com, a recent thing that they had just last month. And I went to find Washington on their list. 47th out of 50 states. 47th. We're at 1,995 as an average. And then I put up here, but the current owner is only paying $992. Well, unfortunately, that is going to be an argument you can't have. For all you know, that person's had that policy for 15 years, never touched it, and it's insured for $500,000, but it's a $2 million house. You have no idea what their situation is. You don't know if they also have 12 other policies where they're getting an additional discount for every one of those policies, driving the price of that home insurance down, right? So getting into that game of, what's the buyer or what's the seller pay? Wow, I'm not even mad or I'm being ripped off. No, it has nothing to do with it. You're having to underwrite today with what the market will provide today, not what you had. Does that make sense? It's no different than if you try and go buy a stock right now. What do you pay? Current, you can't go play. But Microsoft was $1.14. I want that one. Can't do it. Well, insurance is no different. Okay. And so while I'm having fun with this, I just want to bring that to everybody's attention. It really doesn't matter. And I talked a little bit about insurance as a contract, not a commodity. There's exclusions, there's conditions, there's definitions inside of it. And then this is one I want to have fun. I thought there would be a lot more folks in here today. Didn't realize most folks are going to be online, but I'll just say this. I bet most of you didn't know that inside an insurance policy is an exclusion that says if you're in the act of meeting people with your vehicle and you don't tell us that, we have the right to deny any claim you present to us. So what I did yesterday is I went to Google and I asked the question. So, everything has to get caught up. So this is one of those deals for the last 20 plus years I've been trying to help people understand, and there hasn't really been supporting documentation other than here's a lawsuit, this is what it said, here's why they didn't get paid, right? So now you can actually Google, can an insurance company deny my claim if I use my car to meet clients? What did Google AI say?
Said yes.
Yes, because there's enough information finally filtering up from all these folks getting mad about their claims. And here's why. If you're using your car for business purposes, such as meeting clients, notice I didn't say commercial. I said business, okay? By the way, do any of you try and get anything written off when you do your taxes because it's a business expense? So for any of us to think, well, that's not a business thing, probably is not a good path for our thought process, right? It's a business thing. Hauling goods or making deliveries is commercial. So I want to be clear about that. But when we're talking about what I do, I'm right here right now. I drove here. Now here's the easiest way for me to explain this. Pleasure use is what most companies quote because it's the lowest rate for an auto policy. Okay. And then they say, "Would you like to buy my product?" And that's because questions haven't been asked. Do you work for a living? Do you drive to Seattle from Tacoma? You know, nobody's asking these questions. So we're asking these questions. What do you do for a living? And then that next question is going to be great. Do you use any one of these vehicles to go meet clients or go review a house or whatever the case may be? And just so they're on the same page, what I'm trying to help people understand here is insurance is not being sneaky. They're just being honest. We want the cheapest rate humanly possible because we're tired of paying how much it costs for insurance. And so we think if we answer as few questions as possible, we're going to get the lowest rate. Yes, but you're also creating a potential exposure to claim day not being paid out for you. So we really need to have that honest dialogue with an insurance advisor saying, here's how I actually use my vehicle. And so that we're on the same page, it's an average of $200 a year to add business use to a vehicle on an insurance policy. Or you can get a commercial policy for $2,500. That's where they start. So I think it's way smarter just to add the endorsement to your insurance policy. So we have pleasure use, we have short commute, long commute. There's also farm, by the way, long commute, and then business use, right? So if you haul people, do DoorDash, like I'm going to go show a house, but I'm going to drop off this Arby's real quick. That's a commercial exposure. That's not a business use exposure. And really it boils down to the insurance company wants to make sure they're charging you the right rate. And so that way when claim day shows up, they don't have to fire up their attorneys to defend themselves against you suing them because you didn't tell them something that you were bound by contract to do. Okay. Now we're going back to the 22 EV. A lot of people don't realize this when they call to get quotes. Insurance companies use the lowest calculation possible to legally offer an insurance policy. Just being honest, it's the business is what we've demanded them to do. Well, this is actually taken out of the insurance contract that shows you the following. And this is what I want to bring this to. If you're not insured at the time of the loss for full replacement costs, notice it didn't say for whatever that loss cost is.
Right.
Full replacement cost of this structure at the time of the loss, the day before, not the day of, the day before, they have the right to make one of two choices. Contractually, good luck suing them. Contractually, now we're going to help you, but it's only going to be actual cash value. You got a $2 million house that found their opinion is it's only worth $500,000. How happy are you? They might say it's worth 1.3 million. Great. Where the other 700,000 go? You with me? Or you're now basically responsible for 20% of that loss plus the deductible. So if it's $2 million loss, you're looking at $400,000 out of your own pocket contractually. Contractually. Now, how big of a situation is this? Well, this is a good example. There's a home that had a little bit of love from lumber. Wanted to say hi to its old friends, I guess. Well, this is where the rubber meets the road. A lot of people don't realize this, and I'm going to show this a little bit more. But there are 6 to 8 different qualities of how a home is built. Does anybody here know what I mean when I say a quadrant home? Yeah, I see some heads bobbing. Okay. Is that a high quality home or a lipstick on a pig kind of home? Right? I mean that respectfully. There's quality building, right? Hey, they got the cheapest carpet. It's linoleum or vinyl.
It's entry level.
It's entry level, right? There's nothing wrong with that. I bought my first house in Cherokee Bay, Maple Valley. So entry as you can get, okay? I get how this works. But what happens if you get rid of those particle board cabinets and Formica countertops and put in soft closing drawers and plywood, real wood side cabinets and granite? And you don't tell your insurance company. Which kitchen are they going to replace?
The original.
The original. And again, this can push you into being underinsured. So we actually try and educate our clients and saying, look, there's the standard, entry level. And then there's, hey, I've done a little bit of updating. I got rid of the stapled roof and I went to an architectural roof and the kitchen has been remodeled. The bathroom has a bidet, right? We're not talking about, I have 3-inch granite countertops and gold inlays and that's not what we're talking about. That's this. That's exceptional. That's in La La Land. I don't live there. So unfortunately, most homes are going to actually land an upgraded standard and basic custom. I'm going to show a couple of examples about that here in a moment, but I just want to bring that to your attention. So as you're talking to people about go get a quote, they need to understand, they really need to have this conversation on what is the real quality of this home, because when push comes to shove, do they want 20% of the loss coming out of their pocket? I know it'll never happen to us, right? We're all perfect. We're perfect. Nothing's ever going to happen to us. I'm fine with that. Run with that. But what if it isn't perfect? What if the loss actually happens? And here's what happens with someone like myself. We actually can go down and break down how much of this percentage of the flooring is hardwood, carpet, vinyl, ceramic. There's a whole bunch of other ones. The quality of the bedrooms, the quality of the bathrooms, the quality of the kitchens. Is there any deluxe interior specialties? Is there what do you call the, darn, it's not just drywall. Wallpaper. You got some custom wallpaper. Maybe you've done something fancy in the ceiling. You got some really cool LED lightings going on. Whatever the case may be, you got a wet bar. I'm not going to bore you with all the details, but I just took a little piece. This is about 15% of all the questions we're asked when we're being asked to help a client figure out what it would really cost to rebuild their home. Do you think we can do this in 15 seconds or less? 15 minutes or less? No. So what most consumers do is they just say insurance person, boom. And then the computer goes spit. And then you hope it works, right? So I'm hoping I'm giving you guys is there's reasons behind this. And so I'm going to give you a couple of examples. We're going to blow through these really quick. This is Allstate saying the decision regarding the limit applicable to your dwelling protection, you know, how much it would cost to rebuild your home, is your decision to make. This is their actual renewal policy that they're giving their own client that none of us read. Right? I don't read mine because I'm in the industry. I know what's up. What do we do? How much? Oh my God. Fine. We pay it or we go find a new carrier. We're not reading any of this to understand that the insurance company is making sure by law that they're telling us that all they're doing is we are estimating this, but it's your responsibility to make sure it's accurate. Oh, in case you're just thinking that's Allstate. Anybody ever heard of Costco or Amica? Well, we're going to come back to this one. It's ultimately you who's responsible for determining. They're telling us. Okay, well, what if that's just those two? No, it's also Safeco, Liberty Mutual. Let's make sure you're fully insured. It's your responsibility. Oh, it's not just these guys. Oh, wait. State Farm, the biggest insurance company on the, well, at least in the United States, they're also telling you it's up to you. And they're even telling you, State Farm does not guarantee that any estimate will be the actual future cost to rebuild your home. Why are they doing that? Because you've agreed by contract that you're going to maintain your policy. You're going to maintain the policy. It's not their responsibility. And so if you don't call and tell them you changed the roof, you changed the heating, you changed the air conditioning, remodeled the bathroom, got rid of the flooring, changed the kitchen. If you're not maintaining your policy, how are they going to know? Here's how I like to have fun with people. How would you like me? Well, you might be okay with me at this moment, but how wonderful would you think I might be if every day I called you to say, did you make any changes to your home today? You wouldn't like me after a couple of calls. You probably would block me. Would that be fair? That I don't want to talk to this guy anymore. That's why the burden of responsibility is on the owner of said property. Because the insurance companies don't have the capacity to make those phone calls. And legally, they've been freed of that responsibility because it should be the owner's responsibility, not the insurance company to hold the homeowner's hand. Does that make sense? Okay, so there, and here's another one, USAA. I'm going to stop showing you all of these. It's an endless list. I just wanted to bring your attention. Before I showed you this, how many of you knew that this existed? I see no hands. Okay, well, you're smart, Eric. All right, so not that anybody else isn't smart, but I had a conversation with you and you know what you're doing. So that's good. You have your stuff together on that. All right, so let's give you a quick example. Remember when I said I'm going to talk about this other one back up here, this Amica? Just helped this client last week. Notice that they say if the policy also has the extended replacement cost, there's an additional 30% of coverage. So this math is on this slide right here. So 690 plus 30 grand equals $897,000. Okay. In this assessment, when we sat down and we spoke with the client, they redid the kitchen, they redid all the bathrooms. They have a 6-inch walnut flooring. Okay, so 6 inch wide, it's probably 1.25 inches thick walnut flooring now in their entire home. Okay, 690,000, so they have a maximum of 890,000. When we got done, they said, hey, we're the second lowest build quality. We're not quadrant home, but we're one above because we've updated our home. Okay, that's where we all came into. That reconstruction cost came in at almost 1.1 million. That means they're short 187,915. Bottom line, they now are going to be paying out of pocket 20% for any loss that happened at home. Even with all the extended extra, here, we're making you feel comfortable insurance product that they had on there. Here's the lowest rating. This is what I want to bring into your attention. Even today, the lowest rating possible still came in at 827,000. That's how underinsured they currently are on their policy. And by the way, they bought this home 5 years ago. So you have to monitor your policies every 2 or 3 years. That's my advice, okay? You've got to make sure, up and down. The wood doesn't cost as much today as it did a year ago or 2 years ago, right? So but the labor is kind of countered it, but don't get me wrong. And then here's the upgraded standard. That's the number I was telling you about. And then I wanted to show them basic custom so they could see the difference. Like if they had 2.5 inch granite countertops and they had custom this, custom that, that's what that would be. So I just wanted you to see that that's how that works. We go through all those details to come up with those answers. Now, here's a quick example of this. Again, that's why, again, as we're talking about this, I'm talking about why it's important that the 22VV be the next phone call after the celebration. Okay, has to be the next phone call. This person built this home in 2002. It's 2,100 square feet on the first floor, so it looks like a Rambler, but there's a 1,980 square foot fully finished walkout basement below it, so it's about 4,000 square feet. 10-foot ceilings. They have a full wet bar and wine room, a 1,510 square foot balcony. Anybody want to guess why they put that big of a balcony on the back of the house?
View.
They have a beautiful view. I would say it's worth at least $10 million for you guys in real estate business. It's worth it, totally worth it. All right. They have a full fire suppression system. This person might have been a person that worked in the fire department and said, I don't care if the requirement is 5,000 or more. I want to protect my home and put a fire suppression system in their home. They have a chef's kitchen. They have an elevator. One of the folks that is wheelchair bound, but they want to be able to use everything in the home. So they installed an elevator. They have radiant heating throughout. They do have 2.5 inch granite countertops. Okay. They also have detached structures, a fully enclosed barn that's heated, electrical, plumbing, blah, blah, blah. They have a big lean-to. They have a 22 by 44 ADU. I don't know how they got that through the permit process. That's a big ADU. Then they have, it's all private. So they've got powered gates in the front. So they're 2 8-foot, to make a total of 16 security gates. They have 2 huge columns that are completely stoned and beautiful. And they have an 846 square foot detached garage. Here's why I bring this to everybody's attention. This is how it's currently insured. Do you guys feel that we're in a good spot? Okay, ADU. Let's go back. ADU, a 32 by 44 fully enclosed barn, a lean-to, the security gates, an 846 square foot detached garage. And all they have is $135,000 in separate structure coverage. We haven't gotten into the house yet, which is where you thought I was going. We haven't gotten into the house yet. And notice all these say arson, $1,000, $1,000, $1,000, 100,000, 1,000. This is exactly what we have done as consumers. The insurance company has found a way to give us the lowest possible premium, which is 100% to their advantage, because on claim day, they're going to be able to say, you were supposed to maintain the policy. You chose what you chose. Contractually, sorry. Have a nice day. And you can hire all the attorneys you want. Go have fun. You're just going to be wasting a lot of money because it's contractual. Now, can an attorney find a loophole here, a loophole there? Sure. But do you think that attorney is going to find, you'll see the loophole here in a second. So they do have a 20% extended replacement clause. The other one was 30. All right. And so that brings them to a $1.6 million total that this policy will ever pay out. Well, when we ran what their basic custom home is, it was $2.5 million. They're underinsured by $900,000. That means if this home has any loss, $100,000 loss, they're looking at 20% share in that loss, contractually. Now, how happy are they with that company or that agent at that moment? What if the loss is a total loss and the fire suppression system didn't matter? Anybody want to write a check for $500,000 just so they can rebuild their home? Everybody okay with that? So my point to all this is, even if you look at how much they're currently paying, that's how much they're paying for that State Farm policy, $24.61. Okay? I'm actually saying, I want to give you a proposal of 2.8. I want us to have a conversation about, well, how about if we don't do the minimum calculation? How about if we give ourselves a little bit of a buffer? Not a ridiculous buffer. We're talking about 300 grand, okay? Let's not do a ridiculous buffer, but we're gonna counter this cost by going to a $10,000 deductible. I don't know if you guys noticed or not, but with State Farm, because it goes to the percentage, which we're coming back to here in a second with the 22 VB, they have the 0.5% at still $6,700. So, and that will move as the dwelling coverage goes up, right? So even if they called State Farm right now and said, I want to go to $2.8 million, I guarantee you they blow right past the $3,200 quote that we're handing them. They're going to blow right past it. So let me ask you, do you think it's worth $800 a year for another $900,000 in coverage? No. By the way, how much am I covering them for those separate structures? 570 grand. Now, that doesn't cover all of it, but what I did say, and I did have a conversation, I was like, if the house burns, your detached garage is probably not gonna burn. But the barn is close enough it might, and the ADU is close enough it might, right? You see, now if a forest fire comes through, all bets are off. So we have this conversation to say, look, I'm not trying to come in here and just throw up insurance on you and say, let's cover everything. How about if instead we build a strategy that says, let's worry about your risk tolerance and where you think you're gonna land, and what is realistic. Not the sky has fallen and now let's insure for that. I consider that over insurance and unacceptable. We need to figure out what the real loss should be. Just so you know, they raised this to 25 grand and it dropped that $700 a year and they were happy and hugging. So we do have to talk about that as well. The deductibles matter. Think about this on the 22 VV. What did I just do for that darn real estate agent that put 0.5% down? They just blew up their deal.
Wow.
But is this not logistically or logically appropriate for a $2.5 million house? In fact, I have something here. There's another one here, 2,690 square foot. Here's how all those break out. From 940,000 to $6 million. Yet when we call to get a quote and we don't have a list of questions being asked, what quote you think you're getting? You're getting standard 100% of the time. So it's critically important that we get the right number. Now I'm going to use this as an example. Anybody recognize that zip code? I'll give you a hint. Starts with a B. It's down south. Battleground. Okay. I'm doing this deliberately. So this is our proprietary system. Let's say you don't know what your reconstruction cost should be, and we're just having our initial conversation and we're showing you what you need to be thinking about. We'll actually put in the zip code, the square footage, what type of home. If we want to just say it's standard, it was built after 1945 in Battleground, that 640 to 860,000 is the average. Okay. Anybody want to guess what that looks like in Bellevue at 9804004?
2 mil.
Same structure, same quality. Notice standard frame, 2200. But people don't think that. So when you're talking with a mortgage broker that's just going, whoosh, 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 they're putting $1,000 on their line item for pre-approval. We haven't seen $1,000 home policies 15 years. And what happens if you actually insure them properly? Is that client going to want the $1,000 deductible? Because here's what's going to happen. I'm going to have a conversation with them. I'm going to say, okay, let's say you have a $5,000 loss and you're paying $2,000 a year for your insurance. You're going to lose a 10% no claim discount. You're probably going to see a 30% surcharge. So your home insurance is going to go up 40% for the next 3 to 5 years. Do that math. Do you really want to make a $5,000 claim? Because they're going to get all your money back out of you over the next 5 years. And don't forget, you also have to pay a $1,000 deductible. So you got to put that in there, right? So the conversations I have is more about a strategy. Why then give the insurance company money for a $1,000 deductible? Why are we still doing that? If we bought a home 20 years ago and it was a $1,000 deductible and it's 20 years later, how much is milk costing us today? Why is that deductible still sitting there at $1,000? We have to go, if you actually brought it up, you'd probably be at a $50,000 deductible. But let's start talking about $5,000, $10,000 deductibles and watch that insurance premium come down. So as we talk about the 22 VV, that deductible, that percentage thing is going to be, you're really going to need to know the house. You're really going to need to know your client, and you're really going to have that conversation with them to say, we need to think about a logistic or a strategic way. Do you want this house? So what you don't want to say is, if I can't get a $2,500 deductible, I can no longer buy this house. You don't want to do that to yourself, right? You see where I'm going with that? So you're going to want to be really careful with that documentation on what you're going to do. This is just a quick snapshot. Just wanted to show you. I was talking about that client for the $2.8 million in costs. We actually create a side-by-side that actually breaks down what they're currently paying and what their current coverages are. Now, there's a lot of colors on here, so forgive me, but you'll notice I took them from $8,353 a year to only $9,099, and I doubled the coverage on their auto. I doubled the coverage on their motorhome. I actually gave them coverage on their 1969 Cherry Mustang that was comp only at State Farm for no agreed value. We brought it over here at agreed value, properly insured their home. They had a diamond that was underinsured that needed to be insured properly. I took them from $1 million umbrella to a $5 million liability and a $2 million underinsured motorist coverage for $700 a year. Who wouldn't write that check today?
Oh,
Right? But if you don't have a conversation with someone like myself, there are several of us. It's not like I'm unique. I'm not a unicorn. There are several of us. If you don't have an honest sit-down conversation like you would your CPA and you would your real estate attorney, you're probably shooting yourself in the foot. Just because I'm talking about doing all these things correctly doesn't mean I just broke you. And remember, right here, I'm talking about a $10,000 deductible. He dropped another $700 off that, going to a $25,000 deductible. What just happened to that price? Guess what his wife was? Super happy. My husband's amazing. Because she didn't want to spend any more money. That was her objective for him. And it happened to work out in this situation that he satisfied her, but he's also, ex-fireman. He understands risk and all this other stuff. And he wanted to make sure that he was properly insured, which is also why they're absorbing a $25,000 loss. And by the way, with this company, there's a whole bunch of other things I could say, but if there's a loss over $100,000, they waive the deductible anyways. So I include that as a part of our conversation. And there's a whole bunch of coverages. You see all this red? I've only focused on two. I've talked about the dwelling value and the other structures today, but look at all these other coverages that impact you on claim day that we actually walk people through to help them understand. So that's about me. Now let's go back to you guys. So I hope I've helped you understand that this is actually a lot more important than you think it might be when you say, hey, we want to protect you. We want to make sure that you can actually buy this home. We have to have a pretty good feeling on what that value of that home is going to be and how it's going to be insurable. Have a real estate agent, excuse me, I'm so sorry. Have an insurance advisor in your back pocket. Hey, Frank, hey, Shirley, hey, Mo, whatever. I got this situation. They may not come to you, but can we talk about this really quickly? What's this look like in that area? So let's say you called me about Lake Chelan right now. I'd say, please call Allstate, please call State Farm, or call me and I'll get you a Chubb, Cincinnati, or a pure surplus lines policy. But the only way you're gonna have access to those is we have all your other stuff. So I'm just being real. That's my advice. Now let me ask you a question. Do you think State Farm or Allstate's gonna do the job that we're doing? But I'm being honest, I'm telling people this is where you can go get this information. So you need to interview those individuals to make sure they've got your best interest at heart, right? And when you talk about an agent that works for a State Farm and Allstate, American Family Farmers Insurance, USAA, Geico, they're paid by that company. They're not able to go, hey, this company over here's got a better deal. When you work with a broker like us, we have over 600 carriers at our disposal. Guess what we're gonna do? We're gonna find the right carrier for that situation, right? So I want to dig in here a little bit. Oh wow, I didn't see that. It put that on there. That's nice. We're talking about the 0.5% or 1%, leaving that blank. And I will say one of the great things that they did on this form is they're talking about the purchase price. That's going to help in most situations, but I would say 5 years ago, that should say reconstruction cost. And the reason I would say that as an insurance advisor is because it's not unusual for this scenario. If I buy dirt and I now want to build a house, it's going to cost me more than I just bought the neighbor's house. Would we agree with that? right? It costs more today to build than it would be to buy that one. That's already got the dirt on, that already has the view, that's already been lived in, it has all the permits done, it has running water, it has the sewer. You see where I'm going with this, right? So it is not unusual that I'm gonna talk to somebody and they say, hey, we need the purchase price as the insurance, and I have to have the conversation with both the mortgage broker and the buyer. That isn't what we're gonna do. If I try and insure you for what you're paying for it, one, you're not gonna ever see an insurance policy pay for the view. It's never gonna pay for the dirt. It's never gonna pay for the access, the ease of access to highways and interstates. We can only talk about what it would cost to rebuild the home. Now today, because lumber costs and stuff have come back down, now it's pretty close to the purchase price and stuff like that. So there's nothing wrong with that saying purchase price right now. But you want to be careful with these deductibles. You're going to want to make sure that you're having that conversation with them and that there's enough time. Next, flood insurance. I'm going to kind of hit on this one a little bit. And so I'm going to come back to that. But all of this, wrong. The lowest deductible that you can get from FEMA National Flood Program today is $1,250. That's the lowest. The next one is $2,500. So you're forcing your buyer to buy the most expensive insurance policy because of that and how it was written. So please don't leave it blank. Please have that conversation with the client to say, and Google all this. Everything I'm telling you, it's not like I'm trying to be weird. This is like legit. This doesn't work. They didn't talk to an insurance advisor when they rewrote this. and remember, I work in the industry. I don't work for the industry. So I don't have any influence on how insurance carriers decide to do deductibles and rates or anything along those lines. All they can do is advise what they're doing. Does that make sense?
Yeah.
Then we get down here to earthquake. I have not seen an earthquake policy in my entire life with a $2,000 deductible. Have any of you? What do you normally see? Anybody?
The 5?
The lowest I've seen is 2.5%. Percent.
$10,000.
Percent. Oh. The lowest I've ever seen in my entire life is 2.5%. Most companies that are even offering earthquake today, their minimum is 15. Dang. That's why I'm bringing this one specifically to your attention. 15. Okay. Now, as we talk through that, I want to give you guys some key points right after the celebration of an offer being accepted. One of the next business calls, because you might want to call mom. Yes, someone you might want to call, right? Fun, have some fun, celebrate. But your next business call is to their insurance advisor, not the painter, not the designer. I hope I'm getting that point across. Y'all agree with me so far? Yeah, okay. And then they need to obtain a fully underwritten. Remember earlier I was talking about quote and binder. They need to obtain a fully underwritten and ready to issue quote in writing. Here's why I'm saying this. I was just telling Eric, it's an amazing start to the year for me personally. I usually help about 3 clients a week. And in the last 10 days, I'm helping 21. It is just awesome. And we all know about feast and famine. So guess what I'm doing? Okay. All right. So when I say get it in writing, I'm saying you want an email from that agent saying, this is ready to issue and it has been fully underwritten. Please get with your mortgage broker to make sure that the closing date isn't going to move. I know they're asking for a binder, but if I go to a binder, as we talked about a little bit earlier on, if you change that closing date and you're with a company, and I can use companies like Travelers, Progressive, Cincinnati, Chubb, Pure, I can go down the list of these companies that will say that was frozen in time. That policy is going to need to be canceled. And now we're going to requote based off of today's rates and underwriting guidelines. And I can tell you currently, remember in the mortgage industry where it seemed like every Monday morning you had to read 14 pages of what changes happened compared to last week when you're helping clients? You know what I'm talking about? I know that we're not in the mortgage, but you know what I'm talking about. Like the client thought they had a 6.5%, now it's 6.25%, and they no longer qualify, or whatever the case may be, right? There was this moving target of what's currently acceptable in underwriting. That is where we are in insurance today. On a weekly basis, just know that things can change. It's not daily, but it's on a weekly basis, things can change, okay? Here's the bottom line with this. Insurance companies can control how, excuse me, I apologize, I said that the wrong way. The insurance commissioner's office, that is in our best interest, can tell the insurance companies how much they can charge for their product. and how much the rate increases can be. But guess what the insurance commissioner cannot do? Tell them what their underwriting guidelines are, what's acceptable and what's not, where they're gonna sell the product, where they're not gonna sell the product. Does that make sense? So as we go through that, and we already beat this to death. Why are we still having $1,000 deductibles insurance policies? The rebuild cost of the home has gone up over the last 20 years. The insurance advisor will work with the mortgage broker. Here's what I mean by the advisor will work with the mortgage broker. It's not unusual that I'll get a call from, let's just grab Movement Mortgage out of the air. And they'll say, hey man, this guy's really on the edge here. They're like, is there anything you can do with this policy? And here's what I'll say to them. Yes, how high of a deductible will you allow us to go? And I'll get that number, like maybe it's 2.5% of the sale price. I know everybody's a little bit different. I'm like, great, so I can go up to 25,000, boom, that's gonna drop it $1,000 right there. What I'll do is I'll peel off building ordinance and law endorsement and go back to standard. I'll get rid of the sewer water backup. I'll get rid of the sewer line, utility line coverage that they want. But now I'm gonna go to the client before I give that quote to the mortgage company. I'll say, this is the strategy so you can buy the house. We're stripping all these coverages off, but the number one most important dwelling we're not touching. And we're gonna raise your deductible. The day of closing, when they hand you the keys, I'm asking you to send me an email, authorize me to put it back to how I originally quoted it, so your coverage is where you want it. See how I did that? Okay, instead of blowing up deals, because the financing is, the debt to income is a really touchy. We have a lot of single families, right? I mean, we do. And so this becomes a real situation, right? The bread and butter. So the binder means the policy is issued, closing date implications we have already gone over. I have already gone over the earthquake deductibles, preferred carriers. Now we're going to talk about flood really quickly. A lot of people don't realize this, but private flood has actually come into the market very strong. Okay. When we talk about national flood, here's the situation. Let's just even talk about the inexpensive home for $690,000. We already know it should be insured for $900,000 at minimum. But let's just say that we're talking about a $690,000 house and it gets flooded. FEMA maxes out at $250,000. That's it. They're not going to give you another dollar. $250,000 and you just lost a $700,000 house. How happy are you? And I'm being fair here. Mortgage brokers are going box check, box check, box check, box check. They're not going analyze, 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 analyze. If they were, a bunch of the homes that you're selling right now would probably be kicked back because they went with an insurance carrier that doesn't meet their underwriting guidelines of an A- or better rated carrier. There's a bunch of companies out there that are a B+ that do not say A-. So they don't meet the financial stability that they're agreeing to with that finance company. Okay, so why am I bringing this up? Well, we can insure the structure for what they actually need. We can insure for the replacement cost of the interior products that they have in here. And instead of there being a cap, I don't remember what the cap is, I believe it's 100,000 for loss of use. What if you can't live in that thing for 3 years? Where are you gonna live now? Right, you gotta worry about all these coverages and how they work. When we talk about private flood, the bottom line is they can customize it to what your needs actually are, and their rates are very comparable to national flood. Of course, if we have a $2 million house, we can't look at this $2,200 rate and then this $6,000 rate, say, you lied to me, it's not the same. Yeah, because we're covering you for $1.7 million more. Of course, the rate's gonna be slightly different. But in comparison, if we went 250, 250, 250, these would all be fairly close to each other. Another big deal about this, they can go from a no waiting period to a 14-day waiting period where national flood requires a 30-day. Policy won't go in force for 30 days. Okay. Now there are some companies that are allowing the box to be checked. This is for a mortgage, and they do allow some flexibility in there. But what happens with most folks? Let's say 5 years ago, when did they call the insurance company? 5 days before closing, when the mortgage guy is saying, "Where's your binder?"
Yeah.
They're not calling them the next business transaction like we are talking about today. So what do you think happens? That home can't close because the flood policy won't go in force that the mortgage is requiring because of its risk for 30 days or 14 days or 15 days, whatever that case may be. So now everything's moved. You see where I'm going with all this?
We
Okay,
had one of those a couple of years ago.
so there you go. So we have to be careful about that. Let me give you a quick example. This is an actual client of mine. I'll just say, they had 15 properties that were impacted by one flood. So basically, this is a landlord that purchased a whole bunch of buildings. When they first talked with me, they had national flood, so the maximum amount of coverage he had was $3.7 million on those 15 properties. That's 15 times 250K, just so we're on the same page. And what he actually needed when we got done doing the reconstruction cost was 12. Unfortunately, he did experience the loss. But let's just say hypothetically, there was no loss. That he was paying that much for his insurance with national flood. This is how much he paid for what we offered him, but yet we still provided him $9 million real money more in coverage than they were getting with national flood. Okay, I'm just trying to help folks understand that's only a $7,300 increase in cost. And what is a person that owns a whole bunch of properties do? All this is getting written off anyways. How about if we just properly insure this stuff for the right reasons? And if you don't want this policy, then why are you paying for that policy? Save the money, put that 33 grand in your back pocket and call it a day. Now you're going to sell dirt and just get out of the business. I'm just being honest, right? We can have that conversation. There are some people that have a high risk tolerance and are like, that's exactly what I'm going to do. I'm going to go on an extra vacation every year. Great, because they feel it'll never happen. And unfortunately, it happened last year. All right, so a couple of tips. I'm asking everybody to please consider take insurance out of our lives as much as possible. While I've been talking about how to properly do things correctly, I'd like us to start kind of thinking about insurances for catastrophes only. It's not a mailbox that's used for convenience. How about if I just say it that way? Just think of insurance as being a catastrophe only. We can do that by doing wildfire control. We can do that by making sure we have the right electrical panels. And a lot of insurance carriers are offering Ting for free right now when you have coverage with them. This plugs into the outlet and it'll actually sense when something's wrong with the electrical. It's really impressive technology. You can actually tell when there's shorts happening and it'll send an alert to the insurance company. And the insurance company will call you and say, hey, the Ting went off. Have you contacted an electrician to come take a look at your house? Do you think that's a better option or come home to your house burned to the ground? All right, and then we can talk about sump pumps, pools, trampolines. There's all kinds of things that we can do with this. But my number one that I'm asking everyone to do, please, is have an automatic water shutoff installed in every home, everywhere. 48% of all losses when it comes to insurance are water related. And just for support, water damage by the numbers, at least 40% of water losses, so remember we're talking about just the water losses, could be mitigated or avoided by installing an automatic water shutoff valve. I will use myself as an example. We spent a little bit of money remodeling our home. So the entire first floor is redone. A custom kitchen, we'll just call it a chef's kitchen, really nice granite everywhere, even put a buffet, it's got wine racks, it's got all kinds of stuff, it's awesome. It took almost 18 months for all of this construction to happen, because of course, we paid all the contractors in September 2019 to start the project January 2020. What happened? COVID, right? All right, so why am I mentioning this? Well, it took 18 months for all of those supplies, we wanted Viking, and then we said, okay, we'll do wolf, and then we went, now we have to do Fisher pay cow. What do you mean that's the only one? Quick, go get the truck. It's like, I can physically touch this one, they can't have it. So there was a lot of challenges that we went through, right? Supply and demand and stuff. So here we are 18 months later, my wife and I are literally 2 days away from finally getting that last contractor out of our house. I love all the contractors, all of them. We finally got that last contractor out of the house and we're having dinner at a restaurant in Bellevue. And my phone goes off. And I had this thing into the water, out of my water shut thing. My first reaction was, oh, this piece of bloopity bloop. Got it. Call my next door neighbor, is a friend of ours. I said, hey, Bob, would you do me a favor? You go over to my house and see if this thing is just being dumb. Calls me 10 minutes later and goes, dude, there's water all over your kitchen. And I went, whoop, and I told that thing to turn off the water. Honey, check, we got to go home. Here's why I'm even bringing this to your attention. Brand new kitchen, brand new dishwasher, brand new piping. The plumber put all brand new piping in our home. You would think this would never happen. It won't happen to me. Well, what happened is we paid extra for those stainless steel rope looking lines that have an automatic water shut off, so that if something goes wrong, it's supposed to stop the water. The hose came off, but they shut off. So it was just flowing water underneath that dishwasher throughout our entire kitchen. So it did save our bacon. I didn't have to file an insurance claim. We used every towel that we could find, a paper towel, and had to go to Costco the next day to replace all of our stuff. But that was much better than the average time that people are out of their home after water loss is 4 months. Out of their home because of the damage to the home. So these are the companies that we do recommend. I actually am a huge fan of Beagle Services. They offer all of those automatic water shutoffs, but this is like their bread and butter. They want to actually help people do this. I don't get any kickback. There's no bonus, there's no spiff, there's no high five. I'm just saying, if you think about me being in this world for the last 22-ish years, that's the only company that I can recommend to put a water shut off in any of our homes. And you gotta think, I'm also talking about ultra high net worth clients as well. We're not just talking us. And
What's typical cost, you know, for something?
here's what I would tell everybody. You can go to Amazon and find a $79 water shut off valve. Good luck. I do not recommend anything under $1,000. I can't do it. And it's because I wanted to also include the app so that you have the power to turn the water on and off. It'll give you warnings. I like the app feature. These cheap ones don't have the app feature. They're going to charge you about $1,000 to $1,500 to install. The one that I got installed, the total cost was $2,900. And that was the leak defense.
Yeah.
I love it. It's fantastic. And when the plumber came out, you know, there's updates and stuff. So they said, hey, we can redo this. And in fact, I can even give you an extra hose bib out here if you want one. I'm like, how much? He goes, $100. I said, do it. Drilled a hole in the wall, threw in an extra a bib for the outside. So now I don't have to run the hose around the side of the house. I got a hose right there, right? Stuff like that. But I'm just saying, do you want to live outside your home, or do you want to have something that can prevent you having a significant loss? And that's what this boils down to. And I won't bore you with all this, but I even brought in support like Moen, other major insurance analysis, LexisNexis. It's real. The best thing for us to do in our home right now is put an automatic water shut off to prevent additional losses. Insurance tips, I won't bore you with all of these things, but bottom line is, please interview who you're going to work with. What really should matter is the relationship that you're creating with that individual, and make sure it makes sense, okay? And make an investment of your time. How much is $500,000 worth to you? How much is 200 grand worth to you? Why would, and I know I do a lot of these presentations. One of the jokes I say is this one. How many people spent more time on Amazon this week than they did all of last year on their insurance?
Yeah.
Answer? Did you spend more time on Amazon than you did with your insurance?
Oh.
Pick something else. Nordstrom's, Target, I don't care. ESPN. You spend more time on those items than we do spending time on our own insurance to make sure all the money that we're paying and all the investments that we've made are properly protected for that bad day. Okay. And I'll use I want to say Cassandra, that's not right.
That is right.
It is right. Okay, good. I have it pictured differently in my head. So Cassandra, how happy would you be after helping someone for 15 years, getting their finances in order? They're at like a $2 million threshold. Everything's looking great. And they come to you and say, I need $700,000 to rebuild my home.
It happens more often than you think.
But how happy are you?
We're never happy.
No, absolutely not. This is why having a relationship with someone like myself, there are thousands of us across the country. There are 692,000 licensed agents in the country. I'm saying there's probably about 2,000 of us that do what I'm telling you. Most everyone is click, 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 boom, boom, boom. Is it any different in the financial world?
No, you can find somebody you trust.
Is it any different in the real estate world? No different than lawyers. It's no different than you have to find the person that really fits with you and has really got your best interest at heart, okay? And so I won't bore you with all of those. Insurance blunders are going to multiple agencies. A lot of people don't realize this. If you go get his quote at Safeco and that agent just goes, quick, 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 because I got 12 more clients, boom, rejected, darn. Guess what? It blocks every agency on planet Earth because they didn't answer the questions that are relevant to that property. And now maybe Safeco would have been the better target. And no amount of me having a conversation, convincing an underwriter, I don't know, because that's a volume company, right? To say, turn off that decline. I've got your back. We're going to make sure this works out well. So that's one of the things, and stay away from the 15 minutes of stay away from the quotes, get an underwritten quote. And I'll just and finish with that and see if anybody has any questions. Other than that, that's my gig.
Zoom people, anybody? Yeah, thank you, Doug. That's Yeah, this is exactly why I wanted you to come in and talk about that form, because we just don't know. I mean, and it's clear. Saul.
Yep.
Yes, used you.
Yep, so is Jim, yep, so is Tony,
Tony, Kelsey.
yep, yep.
So, I mean, it's kind of
I
like.
should say Kelsey, not Tony.
Oh, that's true. That's true. It's all Kelsey. It's all about Kelsey. But yeah, no, we greatly appreciate you coming in and talking today. It's true that insurance is just, it's one of those things, like you have to get it. You get it the one time and you're right. Most people, they're getting that standard and they're not really understanding exactly what the coverages are, and just seeing the difference of what you did for one customer on that breakdown. And the difference in coverages and the things that it's like, it's a no brainer. I mean, we really should slow down and take a little bit more time with our clients to look at those things, but we'll send this out.
If we're start paying a buyer, we just send them to you via.
I like a warm introduction, if
Okay.
that makes sense. I like introduction. And I want to be fair. That was one I just did last week for a client. There are times when that client has to pay $20,000-$30,000 more because that's how bad their situation was. So I don't want everybody to think I'm this magical individual. And sometimes I save them 2,000 or 3,000 because
Yeah,
it was
the other
wrong.
way.
Yeah, so please don't think of, hey, this guy's no, it's gonna be whatever yours is what yours is.
I imagine probably at least 90% of the population is underinsured though, right?
According to Safe Though, which is one of the pages I put up there, 52% of every home in the country is underinsured, and in that 80% category, 52%. That's their numbers, not mine.
So that's bad.
That's super bad.
All right, thank you guys so much for making it today. We will talk to you guys later and see you on the next one. Bye, guys.